It is the first week of the month and the first show of the month. This is the Trading Bell. Good evening and thank you very much indeed for joining us. Welcome for another dose of market wisdom. My name is O'Brien Kimani. While we take a look at how the markets are performed, and of course, we give you real-time information where to invest and how to invest. Right now, I am joined by Karita. She is the Executive Director at NIC Security to help us understand the market even more. Right. Thank you very much indeed for joining us.
Thank you for having me.
Oh, appreciate it. Please. Catherine, I want to find out from you,
Yes.
when you look at the performance of the Nairobi Securities Exchange
Yes.
vis-a-vis the performance of JSE, Cairo and Nigeria Stock Exchange, what conclusions do you make?
Well, markets are very cyclical in nature, and what we've seen with Nairobi Securities Exchange is in the last, say from mid-2015, we've had a little of a downtrend, and obviously that sort of accelerated in 2016. Last year we closed at 21% down, but what you see is sometimes all the other macroeconomic factors will affect different markets at different times. And so investors will normally shift cash flow depending on what they see. Our problem started in 2015 with currency. Factors such as even the US hiking the prime rate affected us slightly into 2016 where we had the interest rate cut. So you have a lot of factors that would play into each different market, but we find that investors sort of move the cash where the environment is more conducive, where the returns are sort of more promising. And between all those sub-Saharan markets you mentioned, you'll always find investors shifting in between. When they exit Kenya, they might park money in Egypt, might do so in Nigeria. But I think overall, it hasn't been very, very glossy for those African markets. We've had better years, but I think Kenya has been hard hit of the three.
Yeah, and I mean, you know, we all know that markets go through a cycle, you know, whereby they take a dip. But this is one of the worst performance of the market, whereby you have seen the market losing about 25% or a quarter of her value.
Yes.
What are the factors that have contributed to this?
A couple of factors. You know, you'll always look at some of the things even foreign investors look at, and one big one for them is currency and interest rate. In 2016, we saw the government securities having very attractive rates. So what we'd see then is a shift from equities asset class to fixed income. Therefore, again, with less demand for stocks, they tend to just naturally go lower, you know, supply-demand situation. Last year also, you'd also have seen the interest rate capping, which then all the listed banks were adversely affected. Whether it's a perception of the investor that then banks will have to find a new way to navigate or a new way to survive the new normal, was more of a let's exit and wait and see approach. Again, tending to hurt those banking sector stocks, and a lot of investors then had felt it in their returns or in their portfolios, because there was a steep decline over a period of just a week with such news coming into the market. Other things would also just be this market sentiment, how people feel about just the environment. If also right now we're facing inflation has been slightly going up, edging up every time the numbers are out, that could then again affect what, you know, disposable net savings one has towards putting in the market. So there are very variables, all these macro factors that tend to affect how market will be perceived, how market will perform, how the index will then perform, and that's normally what the benchmark is at the end of the day. Yeah.
And I mean, you have mentioned a couple of fundamental issues, you know, that have affected the market for the last 3 or 2 years. We know there is the Trump effect, there is a Brexit effect, and then there's a August election that we are going to have here in Kenya effect. How soon do we expect the market to ease out?
Well, What we've seen already is we're hitting new lows we haven't seen in the last 8 or 9 years. So we're seeing opportunities. We're actually seeing some of the stocks hitting a level we've not experienced, and then obviously a little bit of interest comes in. Not to the levels, obviously, not to the volumes we'd expect, but what we're trying to say is, look, when the valuations are this depressed, and it's not a really fundamental issue on a company's performance, it's just the macro or other factors, as you mentioned, political risk normally ranks a bit high. What we tend to see is it's almost like the best time to sort of average down on your holdings. It's also the best time to pick some of the stocks that the companies are fundamentally sound. It's again all those factors that are outside their control that have sort of affected their pricing. So I would say real easing might come post our election, but I think at some point we're going to see a few moments where investors start to pick up on these stocks, because the correction has to check in at some point. It is a good time to sort of get in and hold. We talk about investments being a long-term horizon sort of savings plan, and if someone has that objective over longer term horizon, it's honestly a good time to net pick on some stocks. Yes.
And have we hit the bottom of the bottom?
It's always hard to predict where that bottom is, because as you said, sometimes you think a stock can't go any lower, and the next day you're surprised. But on a longer term, even if you buy a stock today and it drops a shilling or two, and that before it picks up, as an investor, you might not lose out much because you were buying it for with a 1 year, 2 year outlook, even perhaps 5 year outlook. So we may not be very sure where the bottom is. Some stocks have sort of moved up on the ticker, but then again they could move up, and after a few weeks, show some movement downwards. You never know with the stocks. You never know when it comes to investor sentiments. But we're hoping that on a longer term play, these stocks honestly are very undervalued, some of them at least. And that's what we're saying. It's a good time to get in. You just need to cherry pick and look at what would work for you based on your objectives. Yes.
And, for a market that has lost almost 25% of our value, this is indeed very good bad news for investors, who have invested their billions of shillings. But also it can also be a very good entry point for somebody who wants to come into the market. What is your feeling and thoughts on things?
It's always hard, obviously, for that investor who obviously is sitting on stocks, and you're looking at your portfolio and you're seeing, 20%, 30% down. There are two ways to really ride that situation. One is perhaps buy more to average down. For an investor who was not in the market at the time of, say, a bull run, then it gives them an opportunity to really get in, and an opportunity with time to stand a good chance for real returns. And again, when you look at the market, every 3 years you have a nice run. You may have a 2 to 3 years again where you have a bear trend. So just on the timing, I would say, since we've been experiencing this bear trend since mid-2015, we'll likely start to see a good recovery pick up later end of this year, stronger into 2018. So I would advise investors to actually put some money aside, get some investment advice from your brokers, and start to align to what might work with your objective. And I think it would be a good time to do that.
Catherine, I want to paint a scenario for you here, so that you can give us your thoughts on these. You are faced by two investors.
Yes.
One of them has seen the share of her wealth or his wealth go down significantly, and they want to leave the market.
Yes.
I want you to tell me, what would you tell them? And also on the other hand, there's an investor who has been watching the market go down. They do not know how further down it's likely to go, and they're still waiting for that signal for them to get into the market. What would you advise them?
So for the first type of investor, it's always good to have a clear objective when you get into the stock market. One might even include having a stop loss measure, where you say to yourself, after a 10% or 12% depreciation on your assets, you're likely to just sell, take your 10% loss, and reinvest in something where you feel I can make more money as opposed to waiting it out. So there's always that option of, did you have a stop loss? What were your plans? And if you are sure you want to exit, where are you planning to then move that cash to? That will obviously make up for that loss you've already incurred and give you a probably higher return within perhaps 1 or 2 year time frame. So if the investment they're considering has a promising return, sometimes it might just be worth it to cut the losses, because you know, if I take this 2 million and put it somewhere else, it will grow, as opposed to sort of saying, look, I'll just park it there for a year and then you have an opportunity cost lost somewhere else. So it always depends on what is your next best option. For an investor who's eyeing the market and wondering, look, when's the best time to enter? As I said, it's not so scientific that we know this is the bottom of the bottom, right? We're not that, that good at that prediction, otherwise we'd all be billionaires. But what we're saying is, look at the company you want to invest in, look at their management, look at their strategy, look at how they've been performing over the last, say, 5 years. And then based on that information and fundamental analysis, then you can decide this company is likely to grow. And in times like this, then, you could also just choose to go the defensive way. You have a lot of blue chip companies that are sort of very resilient to market downturns. Yes, they will lose a bit of value, but not as much. And yes, because they're blue chips and their growth is there, you get good returns on the dividend yield. So even as you wait out on the capital gains, you'll be getting some dividend income coming in along the way.
I want you to hold on to this question.
Yes.
Sometimes investing in the market appears to be a very technical issue, or a very technical process. How simple can it be? I want you to hold on to that, because we'll be coming back and having a look at how the market has performed in the last 1 week. Well, Karita is the Executive Director at NIC Securities, joining us here on the Trading Bell to help us understand the market and, of course, help us make wise investment decisions. This is the Trading Bell. We'll take a short break, and thereafter we'll be back with more stories. Welcome back. This is the Trading Bell, and of course having a look at the figures there, and all the 4 indices of the market somehow registering some positive moves here. We are with Karita, who is an Executive Director at NIC Securities, joining us here. Now, Catherine, what do you make of the fact that all the 4 indices of the market are looking up? What has changed?
First, that's very exciting to see. I think we've had that trend the last 2 days. It really, honestly, could be the mere fact that we said earlier, people will have to see this as a time to enter. This is a time to average down for those who already hold shares, or an opportunity to get in for those who have not been in the market. So I think what we've been saying all along is it's time to get in now, and I think we're starting to see a bit of that traction.
Are we entering into a new curve?
Well, it's too early to predict, but as I said, this is like the 2nd or 3rd day we've seen all the indices at least move up, at least the NSE 20 for sure. And it's good to see us, going up closer to at least 2,900, and hopefully we can go back to the 3,000 levels. We hope that more investors will look at this as an opportunity to get in, an opportunity to get into the stocks as they are really, some of them at a high, at a 9-year low. So it would be a good time to make some investment choices at the moment.
Good. And of course, remember, I asked you a question before we took a break, and of course I'll be coming back with that. But before we go there, look at the top gainers here. We have Kengen, we have Mumias. What are the fundamentals?
I think sometimes, well, Mumias, I wouldn't even look at it as a fundamental issue because you see Mumias was as low as a shilling. So I think it's more, sometimes the market is also driven by speculators. And I think it gets to a point you say, look, this stock is at a shilling, how low can it go? And again, for someone who wants to just pick on the penny stocks, it's a good way to speculate and, you know, you're looking at it as almost being at the bare minimum. So what more risk can you take? So I think sometimes the market is driven by speculators and we do need speculators to come and take certain positions to spur activity, and it's probably what's happening with a stock like Mumias. I mean, and again, we always see all kind of investors with different motives. So I think this one is more of a speculative play because as we've seen, there's still a lot of issue around the sugar industry and even within Mumias itself. So I think
So it is not backed by any fundamental
I would
fact.
just call it a speculative play.
Let's move to top gainers and I mean top losers and CIC Insurance, Sanlam. What is happening with the insurance industry?
I think it's twofold. You know, insurance industries have also diversified to doing a lot of asset management as part of their business lines. And you find most of these insurance companies are also getting hit on that front. We talked earlier about the index and where it is. So if you're coming from a full year 2016, their assets under management would have been affected by the performance of the exchange and therefore will tend to affect their earnings. And we've seen with CIC, for instance, that they've already issued a profit warning. And I think the bulk of that is really based not on the insurance model, but on what their asset management returns will look like. So again, it's not realized losses, but it is again sort of not a very positive outlook on their assets under management, which then tend to affect how their financials will look. But, and I said it's two-sided because there's a lot of upside for insurance companies. We now know with marine insurance coming into play and local companies being allotted a piece of that pie, which previously was not something that we've seen them insure, creates upside for companies like CIC and the others. Yes.
And of course, we have spent a considerable amount of time here, you know, welcoming new investors into the market.
Correct.
And of course, also welcoming old investors that this is the time to reinvest. I want you to face this camera
Yes.
and tell somebody who is new and who has never invested in the market, how easy, and I want you to take about 30 seconds at most, how easy is it to invest in the market?
Okay. Well, for anyone thinking about investing, it really is very easy. If you do not have a CDS account, which is a depository account, the first thing is to get that set up, and you can get that with any broker. Then secondly is to make sure that, you know, with your broker, whoever you select, that you're getting some sound information on what to buy, and always be active in your portfolio management. Always inquire, always follow the news, always follow the companies that you're invested in so that you can know the best time to exit or the best time to even accumulate. So it's really just about getting involved and knowing what you hold and what you can do to grow that portfolio.
Good.
Yeah.
Catherine, thank you very much indeed for joining us here on the Trading
Well,
Bell.
thank you for having me, Brian.
Thank you very much.
Okay.
Well, Catherine Karita here joining us from NIC Securities to help us understand the dynamics of the market and, of course, how to invest in the stock market. This is the Trading Bell. Remember, we are coming to you from the trading floor of Nairobi Securities Exchange. Stay right here.
Index is an index that is a constituent of all the listed securities on the exchange, the listed stocks on the exchange. So what the exchange does is looks at the 65 stocks and looks at the volumes moved on that particular day and weights it to find out what the index at the end of the day was based on the turnover of those all the shares and the volumes moved. On the other hand, the NSE 20 index constitutes 20 of the big movers and also of some of the large caps that we have. And the index is formulated by looking at the market cap for those 20, and again also how the volumes have moved in the course of trading. The NSE 20 is also reviewed every so often, perhaps every 6 months. The NSE has a right to look at these companies that form the NSE 20, and based on how they have been trading, either remove them from that NSE 20 or add new members again and remove others that have not been as active. And that always is a good thing to do, so we can have a clear picture of what the index looks like based on the top movers and the big cap companies on the exchange.
And with the NSE historical fact, we come to the end of the trading bell for today. Many thanks indeed for your time. And always remember to get in touch with us through our SMS line, which is 22162. Remember to start with the name Bees or with the word Bees. My Twitter handle is @O'Brien Kimani, @The Trading Bell. And of course, our Facebook page is @The Trading Bell TV Show. Remember, the NSE Investment Challenge for 2017 is also open. For more information, log on to their website www.nsc.co.ke. We look forward for this engagement again next week, same time, right here on KBC Channel 1. We take you now back to Broadcasting House.